tax bill on purpose sounds backwards until you understand why some retirees choose to do it. Hi, I'm Phillip Smith, financial planner with Tide Pool Wealth Strategies, helping you figure out how to retire with confidence when you're nearing retirement and helping you build a plan that adapts as life changes when you're already retired. Welcome to
The Perfect Retirement Plan.
Roth conversions are one of those topics that once people start hearing about them, they start assuming they should just inherently understand. But they don't feel comfortable admitting those areas that they don't understand about it. And the conversation topic weaves into a discussion about taxes, which already makes most people just simply want to tune out. So instead of digging in, people can tend to mentally file the whole thing under, I'll deal with that later. And eventually, for some, a nagging question emerges. Is this something I'm supposed to be doing? Or does it not really apply to me? You know how your phone asks you to update the software and you keep clicking remind me later, or at least I do, because I'm not sure how long the update's going to take, or whether it will drain the battery completely, or what is going to change. Mentally, that place of uncertainty is where Roth conversions can tend to end up living. And honestly, this is one of my favorite conversations to have with people, not because Roth conversions are exciting. I mean, we all know that those kinds of things are not. But because once this clicks, I have seen the stress level drop. I see client confidence rise. Helping people get clarity around this stuff is a big part of what I do. And I absolutely love it. So today, we're slowing this down a little. No hype, no pressure, just a clear explanation of what a Roth conversion actually is, why someone might consider doing one or a series of them, and when it truly makes sense for someone. Or, maybe more importantly for those listening, when it doesn't make sense for someone to do one of these things. So here's where we're headed. We'll start with a plain English explanation of what a Roth conversion is, and just as important, what it is not. Then we'll talk about why people do Roth conversions in the first place and why some people strongly argue that they're unnecessary. And after that, we'll walk through when Roth conversions make real sense, why timing matters, and how they often fit into a broader retirement income plan. We'll also cover how a Roth conversion actually works, using a traditional IRA as the starting point for the example we'll go through. And we should also touch on why it's considered a distribution and not a transfer, and cover what tax forms show up afterward. By the end of this, you should understand this well enough to decide whether it's worth exploring further. This is such a tax-heavy topic that it's important to say this now, not in the closing disclosure that most people skip. I am not a tax professional. I have a tax planning designation, but planning is not the same as interpreting tax law. Always consult with your tax professional when it comes to things like Roth conversions. All right. So at its core, a Roth conversion is simply moving money from a pre-tax retirement account into a Roth account. Most commonly, that means taking money from a traditional IRA and converting it into a Roth IRA. The key thing to understand is this. Money in a traditional IRA is tax deferred, meaning if you're doing it right, you have not yet paid taxes on the money inside this account. The IRS hasn't received their cut yet. A Roth conversion is the moment you choose to pay those taxes. You're voluntarily recognizing the income now, paying ordinary income tax on the amount converted, and in exchange, that money can grow, and if you've met a couple of requirements, it'll eventually be accessible as qualified distributions, which simply means you can take the money out tax-free in the future. This is not a contribution, does not count against your contribution limit. Income limits that apply to Roth IRA contributions do not apply to Roth conversions. Think of it like this. You're choosing to settle the tax bill today, so future you doesn't have to deal with that tax bill later. And before we continue, those two requirements that I very briefly mentioned, in order for the money you distribute from a Roth IRA to be 100% tax-free, you have to be 59 and a half or older, and the Roth IRA must have been open for 5 tax years. I don't want to confuse anyone, but it needs to be said clearly. For conversion amounts, this is a separate 5-year clock on the conversion, which means that even if you're, say, 65 and you just did a conversion, the converted amount can be withdrawn whenever with no tax consequence, but the growth needs to sit in the Roth IRA across 5 tax years before it is tax-free. I emphasize tax years because we're not talking about 5 calendar years, 60 months. We're actually talking about any time within a year you file taxes, that is considered the tax year. December of year 1 counts for the whole tax year for these purposes. January of year 5 counts for the whole tax year. So if you do a conversion in December of 2026, all other requirements being met, you can take a distribution in January of 2030, and it will be 100% tax-free. That's technically only 3 years and 2 months. Now, I do apologize if that seemed like a bit of a tangent, but I have these conversations with clients all the time. I try to be as clear as possible, and hopefully this explanation helps someone. Now, people don't do Roth conversions because they enjoy paying taxes. I have not yet met somebody who enjoys paying taxes. So people do these because of what it can solve long term. One big reason is tax control. Maybe you know exactly what tax rate you're paying today, which is great because many people aren't paying attention, or at least not close attention. Future tax rates, though, those are unknown. But a Roth conversion locks in a known tax rate. We're $37 trillion deep in federal debt. And by putting that number in here, I will have dated this episode. They have 2 levers to close the gap, they being the federal government. They can either reduce spending or raise tax revenue. Yikes. A betting man would say that taxes are likely to go up at some point in the future. Now, another reason people do Roth conversions is to reduce their future required minimum distributions, or RMDs. You see, traditional IRAs eventually force withdrawals whether you need the income or not. Roth IRAs do not have a required minimum distribution that will be triggered at some age. That means Roth money gives you more flexibility later on in life. You can choose when to use it, how much to use, or whether to leave it untouched, and again, very likely to be using it as tax-free income. Now, Roth conversions can also help manage Medicare premiums. They can help reduce tax bracket spikes later in retirement, and they can create tax-free income that pairs well with Social Security. Like, I don't know, steak and a red wine. Definitely not steak and ketchup. And on top of all that, it's a fantastic legacy planning tool. You pay the taxes today, leave the beneficiaries a tax-free pot of money. If you want to know more about that, feel free to reach out or do a little research on your own. Anyhow, this isn't about beating the IRS. It's about being aware of the rules and using them to your advantage. You'll often hear people say Roth conversions are unnecessary. They'll say things like, you'll be in a lower tax bracket later, or why would you pay taxes on purpose? Or I even hear, well, all things being equal, you'll be in the same tax bracket in the future. There's no actual savings. Sometimes they're right, but everybody's life is different. If someone truly expects much lower income later, has small pre-tax balances, plans to live very simply, or knows that their intent is to leave their IRA money to charity, a Roth conversion may not add a whole lot of value. That is the blatant, honest truth. The problem is when that advice gets applied broadly. Roth conversions are situational. They are not automatically good or bad. They either fit your situation or they don't. And sometimes the situation changes, which is why I like to review all of my clients' situation on an annual basis. And this is where planning really matters, because the right answer isn't yes or no. It depends. And I don't usually do a plug in these podcasts, but quite frankly, that's why some people hire our office. They don't want blanket statements. They want judgment, context, and someone to help them think it through. Not once, but ongoing. Our value proposition is relational as much as anything else. Roth conversions tend to make the most sense during certain windows. Early retirement years are a big one. Income is often lower before Social Security and pensions begin. Those lower income years can create a planning window where converting at relatively modest tax rates is possible. They can also make sense for people with large pre-tax balances who want to reduce their future RMD pressure. And another common reason is tax diversification. Having money in different tax buckets can give you more flexibility later. Roth conversions are rarely a one-time event. They're often done gradually, thoughtfully, over several years, intentionally filling up certain tax brackets without spilling into higher ones. Timing matters because converting too much at once can create unnecessary tax pain. This is about control, not speed. This is also where having an accountability partner matters. Roth conversions don't fail because people don't understand them. They fail because life gets busy and nobody helps you stay intentional year after year after year after year. That's a big part of how we serve our clients. So, conversion, distribution, transfer, rollover. If you don't know these terms, it's industry jargon, and commonly I find that people kind of think they're just all the same thing. This is a spot where a lot of confusion sneaks in, so let me slow this part down. People may use the words transfer, rollover, and conversion as if they all mean the same thing, but they don't. When I'm talking with a client, I might use a phrase in this way. Not all money moves are treated equally by the IRS, and each term means something different. A transfer is the simplest. That's just moving money from one account to another account of the same type. Traditional IRA to traditional IRA, Roth IRA to Roth IRA. Same tax treatment, no income, no tax bill, and more formally called a trustee to trustee transfer. A rollover is usually what happens when money comes out of a workplace retirement plan like a 401k or 403b and moves into an IRA. If it's done correctly, it should also have no tax consequences. The IRS has very specific rules around rollovers, but the goal is still to avoid triggering taxes and keep the money in qualified retirement accounts. A Roth conversion is different. When you do a Roth conversion, you are intentionally taking money out of a pre-tax account. The IRS treats this as a distribution, which means it shows up as income. You're choosing to redirect that distribution into a Roth IRA instead of spending it, but from a tax perspective, it's still counted as income. That's why you may hear me emphasize this so much. A Roth conversion is not a transfer. It's not a transfer. The conversion is not a transfer. It's a taxable distribution that you're intentionally using for long-term planning. Here's what this looks like in practice. Okay, so you've had the conversation about whether or not you should. Ultimately, the decision is going to be yours, and so you decide how much of your traditional IRA you want to convert. Your custodian processes that amount as a taxable distribution from the traditional IRA. The money moves into your Roth IRA. You owe income tax on the converted amount for that year. Now, ideally, the tax is paid from money outside the IRA. And side note on this is more of a strategic thing, and I'm happy to chat about it. There is no early withdrawal penalty when this is done correctly. Correctly, with air quotes that you can't see, means if you're under 59 and a half, do not pay the taxes from the traditional IRA. Don't do it. Any amount distributed that is not converted to the Roth IRA counts as an actual non-qualified distribution from the traditional IRA. And since you're under 59 and a half, you'll be required to pay the early withdrawal penalty on that portion. This gets overlooked because it's simply just something that's not common knowledge. Now, here's a quick numbers example of how this would work out. Let's say you're 58 and you convert $100,000 from traditional IRA to Roth IRA. And let's say you live in Oregon. Your federal tax rate in this example is 22% and you withhold 8% for Oregon income taxes. That's a 30% total tax withholding. Okay, so that in mind, you decide to pay the taxes from the traditional IRA, even though I said don't do it. So you convert $100,000, but you pay $30,000 in taxes. So only $70,000 arrives in the Roth IRA. The part that didn't show up in the Roth IRA counts as a non-qualified distribution. So now you have an additional $3,000 you owe as a result of the 10% early withdrawal penalty on the $30,000 quote unquote distribution. Gross. It's the first word that comes to mind. If you can afford it, pay the taxes from somewhere else, anywhere else, and allow the full $100,000 to arrive in the Roth IRA. It saves you $3,000 in early withdrawal penalties, and you have more money able to grow in that eventually 100% tax-free account. Okay, so let's say you did that conversion. Now you have two tax forms that you're going to have to deal with. First, you'll have that 1099-R that shows the distribution from the traditional IRA. Then you also have the Form 8606 or 8606 that tracks the Roth conversion for the IRS. The 8606 can look intimidating, especially if it's your first time seeing. But it's simply documenting what already happened. And it's actually created to document a few other types of things that can happen. We won't get into that. Tax software can do this for you. A CPA doesn't even blink at the thought of this form. And just to say it out loud, this is the point where a lot of people decide they just don't want to do it alone. Not because it's impossible, but because it's easier when someone's helping you connect the dots between the planning, the taxes, and the long-term picture. There are some common misunderstandings and blind spots that can occur with all of this. Misunderstandings are where I see people get tripped up the most. One common misunderstanding is converting too much at once. And I call this a misunderstanding because it is a misunderstanding of the financial impact. Someone says, oh, I'll just do the whole thing and be done with it. Just because you can convert a large amount doesn't mean you should convert a large amount. Large conversions can push you into much higher tax brackets, potentially. They can create surprise tax bills, and it'll ripple into things like Medicare premiums. Now, another big one is forgetting about state taxes. Federal taxes get most of the attention, but if your state has an income tax, then state taxes may still matter. A conversion can look reasonable on paper until you factor in the full tax picture. I also see people pay the conversion taxes from the IRA itself. That usually undermines the whole point of this process. Pulling money out to pay the tax reduces how much actually makes it into the Roth. And in some cases, as I previously mentioned, can trigger penalties, additional taxes. Medicare is another blind spot. Higher income from conversions can increase Medicare premiums later. That doesn't mean conversions are bad, but it does mean they should be thoughtfully coordinated. And finally, probably the biggest mistake I've seen is doing Roth conversions without a long-term plan. I mean, if you don't have a plan, what are you even doing it for? Conversions work best when they're part of a multi-year strategy, not a one-off decision made in isolation. Coordination matters. Taxes, income planning, Medicare, future required minimum withdrawals, they are all connected, whether we like it or know it or not. I think I'm hitting a new episode length record. Probably time to hit those action items. First, understand how much of your retirement savings is pre-tax. And then second, try to identify those future years where income might be lower. Third, talk with a professional, a financial advisor, a tax professional, or both. Talk to them about whether Roth conversions fit your situation today and or in the future. And, if this episode was helpful, subscribe, share it with someone you've heard asking questions about Roth. And listeners, remember, the perfect retirement plan isn't about having the smartest financial advisor, the most money saved, or the highest probability of retirement success. The perfect retirement plan for you is the one you act on. And now, some lengthy episode-specific disclosures to get you warmed up for the regular closing disclosures. Some IRAs have contribution limitations and tax consequences for early withdrawals. For complete details, consult your tax advisor or attorney. Retirement plans. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Roth IRA. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on earnings. A Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes.
It's disclosure time. This podcast is intended for educational purposes only, should not be used for any other purposes. The views depicted in this material should not be considered specific advice or recommendations for any individual, are not intended to be financial, tax, or legal advice, and are not representative of Typo Wealth Strategy or Cetera Wealth Services, LLC. All examples are hypothetical in nature and for illustrative purposes only. The opinions contained in this material are those of Phillip Smith and not a recommendation or solicitation to buy or sell investment products. This information is from sources believed to be reliable, but Cetera Wealth Services, LLC cannot guarantee or represent that it is accurate or complete. For a comprehensive review of your personal situation, always consult with a financial, tax, or legal advisor. Neither Cetera nor any of its representatives may give legal or tax advice. Our office address is 450 Country Club Road, Suite 350, Eugene, Oregon 97401. Securities offered through Cetera Wealth Services, LLC, member FINRA, SIPC. Advisory service offered through Cetera Investment Advisors, LLC, registered investment advisor. Cetera is under separate ownership from any other named entity.